you all for spending your lunch with us today. I know it's getting to be that time of the quarter where there's a lot going on for everyone, so thanks for taking some time out and taking advantage of this opportunity. I'm Laura Haston, the Assistant Dean, in case by chance we have some visitors that don't know me. And it's my pleasure to introduce Lindene Patton today. Lindene is the Chief Climate Product Officer at Zurich Financial Services. She manages the Underwriting Council and the Cost Engineering Services staff. She has substantial experience in all aspects of environmental insurance and professional liability insurance for the design professional, and she supports the development and improvement of all lines of environmental insurance. She has lots of credentials. She's an attorney licensed in the state of California and the District of Columbia, an American Board of Industrial Hygiene Certified Industrial Hygienist. She holds a bachelor's degree in biochemistry from University of California, Davis, and she has her master's in public health from the University of California at Berkeley and a JD from Santa Clara University School of Law. She's on several advisory boards, including the Environmental Financial Advisory Board, and most importantly, she is on the Bren School's advisory board, and was instrumental in developing a strong relationship between the Bren School and Zurich, which led to a significant endowment that enables the school to bring in a number of distinguished visitors each year to help educate and promote research and understanding about climate change issues. So we're very grateful for Lindene for that, and we're also grateful that she's going to share her knowledge today about this important issue related to climate change. So welcome, Lindene, and thank you.
Thank you. Thanks, Laura, and thanks all of you for you giving up your lunch hour, absolutely, and coming to listen about a subject that most people know very little about, but use all the time, and that's insurance. And specifically, what I want to talk to you about today is using insurance, which is a specific financial services tool, to adapt to and mitigate risks associated with climate change. But the focus of the discussion and the materials which I have provided in advance is looking at why this is difficult, predominantly because insurance is focused on protecting private assets. And the focus of management of climate risk is addressing public goods. And the trick is trying to figure out where those two interests align. Because if you can figure out the locus for alignment, you can leverage. And you can get more power out of the instrument in a way that can be used to change behavior and achieve positive environmental outcomes. But there is a flip side. If you use insurance in a way that is designed not necessarily just to address management of a public good, but is designed to purposely reallocate costs or otherwise distort the marketplace in terms of allocating those costs, you may find that the instrument doesn't deliver what you thought you wanted. And that result may not be obvious for 10 years or 20 years or 30 years. And part of what I want to talk about today is why and how that has happened and what it is that we're looking at socially today in terms of deploying insurance to try to mitigate and adapt to these risks, where we might benefit from learning from that history. By the way, an obligatory disclaimer, I'm giving you information to the best of my knowledge, but it doesn't mean it's right. In fact, I could be completely wrong, and all of you who know me know that that's completely true. So the challenge that we're all trying to deal with, you guys get educated on all day long here and probably know lots more than I know on detail issues, is how are we going to integrate greenhouse gas emissions into what amounts to a global operating model? But the big nut that everybody cares about is who pays. All right, this is not free. Basically, we've used the atmosphere as a common. So we just discharge to it. No recognition that that has a value or doesn't have a value. But when it comes down to addressing the issue of who should pay, you begin to look at, well, what do we think the causal sources are? And then we end up in this big, long dialogue about science. People have opinions. There remain disagreements about that. And so where do we leave it? We leave it to public policymakers to make a decision. And the big issue is, who should public policymakers target? And clearly, there is no consensus on this issue either. Okay? So what we have is a situation where we have a governance gap. And part of the materials that I handed to you talk about the issue of the governance gap. Private market tools like insurance and other financial services products cannot fill the governance gap. They do not take the place of the government, but they do respond to the rules, regulations, and directives that are made by the government. So keep that in mind as you think about your public policy making activities. But some of the other big questions that public policymakers as a consequence are now grappling with is, how do you deal with existing capital investments that are either carbon intensive, think coal-fired power plants, or not adequately hardened for climate change? Think about the house that sits on the edge of the forest in terms of fire risk, where the owner decided that oil-based plants were really attractive, and they were just what they wanted to build, but it might not be sort of consistent with the environmental exposures that it has. We, of course, have the similar issues that most of the public dialogue is focused about that happens to be coastal co-location and urbanization of coastal areas. Most of these capital investments look at things like power plants, individual homes, but people forget to recognize that this is all about tax districts, all right? So if what you're talking about are aggregation of non-hardened buildings, weather inappropriate buildings, climate exposure inappropriate capital investments, where are they located socially? They are located in an existing tax district. This is true for flood. This is true for hurricane exposure. This is true for fire exposure. So if you didn't have to deal with the fact that human beings are attached to their neighbors and friends and their communities, and you didn't have to deal with the fact that politicians are attached to structures and mechanisms for organizing economics, as a scientist you might walk in and say, man, you should relocate this community. This is in the wrong spot. Unfortunately, we don't have that opportunity. So in some cases, when scientists come in and look at what are options for hardening or options for mitigating risk, if you took away all the human component to it, you'd say, just relocate the community. But we don't have that option. So now we have to deal with, what can we do and how much does it cost? And what residual risk are we willing to live with as a society to maintain these structures? So where that ends up with is, who has to take action? And what everybody wants to say is, well, not me. How about them? I don't want to do anything. And what it comes down to is, government is ultimately going to have to make this decision. Otherwise, you end up with consistent free rider behavior on an ongoing basis. And a lot of what you see now in the dialogue that you spend a lot of your time learning about is everybody saying, well, it should be them, not us. And these people should be responsible and not us. There are other people who are volunteers and who will do certain things, but then they hit a limit, either as a result of their capital capacity or their personal commitment in terms of what changes they're willing to make. And what about the financial marketplace? The underpinning for the ongoing capital investment under circumstances where current rules, regulations, building codes, and the like continue to permit weather inappropriate construction. And in fact, continue to finance on a basis where the term of the finance exceeds the now predicted useful life of that building if you were to take into consideration the changed climate patterns. Now you're beginning to get a feeling for why this is a really tough intersection with the financial services markets. Additionally, when public policymakers have come initially to talk to the financial services market about this issue, they assumed we were all the same. You're an insurance company. Don't you think like a bank? The banks love this idea of carbon credits. Don't you love them? The answer is, we have very different roles. And the financial services industry is an amalgam of multiple players who all serve very different purposes, and that's part of what I want to get you to think about when you think about the role of insurance as contrasted with the role of venture capital or as contrasted with the role of other types of equity investment or even debt structures, because we serve a different role in the marketplace. But before we go that far, I want to talk a little bit about something you guys have already studied, which is why are public policymakers interested in carbon markets. It's because if they correctly structure a carbon market in one way or another, they can create value where there is none. So unlike most other commodities, carbon credits have absolutely no intrinsic value. In the absence of somebody filling that governance gap, your carbon credit is worth diddly, okay? So you have to figure out how you structure that, and that is a lot of the issue of who pays, okay? And I'm sure you study that in other ways, but it doesn't necessarily address all of the problems, because these market mechanisms, while they are theoretically deeper and less dependent on enforcement for moral hazard mitigation, because they assume inherent motivation on the part of participants in that market to be capitalistic, they don't necessarily address the issue of stranded assets, which are those capital investments that have not yet run their full life, at least based on the structure of the investment profile that was done when you did your initial investment. These markets use economic motivation to achieve sustainability. But the trick is, if you want to build new generation in this area where you're talking about affecting greenhouse gas emissions and profiles affecting essential services, power, water, transportation, and land use, if you want to know how to build new on these issues, our society, our culture, at least in the United States, assumes behavioral characteristics that are dependent on bond-like financing. They expect consistency. You as consumers expect consistency. You expect that if I was paying a particular amount for water, that's just the amount I pay, maybe with a little bit of inflationary adjustment. But you don't expect it to be like buying futures. You don't expect a commodity volatility. So implicit in the predicate that carbon markets and creation of carbon credits, we're going to solve this problem, is the idea, whether people really thought this through or not, that society was going to be willing to trade the basis for the structure of financing and say, oh, don't worry, we'll agree that all new gen can be financed, at least a portion of it can be financed, using carbon credits. So a lot of this discontinuity that people have been looking to our industry for is, gosh, couldn't you insurers, you do everything magic, couldn't you manage that volatility for us? And after we get done laughing, we're like, well, not really. That's what commodities traders doing. You know, that's what commodity trading is about, all right? So what you're seeing is when you start these markets starting to emerge, everybody else is looking for someone else to manage the risk, okay? And a lot of the time, insurance is a great target. But insurance looks to fortuity risk management. They don't necessarily focus on volatility management. In developed markets, so developed commodity markets, or proven natural systems, like when does the sun shine, when does the wind blow? Can we as the insurance industry come up with hedges? You bet, okay? But those are all based on natural cycles. We can study them, we can model them. Implicit in the valuation of a carbon credit is political risk, all right? And so what is being asked of the insurance industry in this context is for us to take political risk. Now, do we take political risk? The answer is yes, but only in cross-border transactions. And in-country political risk is not generally a risk that we absolutely take for new emerging activities. Where there is behavioral characteristics demonstrated in long-term markets, like we know that there are building codes. We know that the building code inspectors move forward and enforce a set of rules in a particular way. Will we take the risk that those rules may change? Yes, because we understand the organic authority of that law and the boundaries within which they have authority to exercise that law. Will we take the risk, for example, that there would be a change of environmental rules within given statutory authorities? Yes, because we know the behavior. We know the likelihood that there are going to be changes. Will we take the risk associated with the potential volatility for the carbon markets today? The answer has generally been no. because the basis and the reason for those changes in the political risk have not been worked out yet. All right? So what are these limitations of this carbon credit? As we've been discussing, they have short term, they've got spot and futures characteristics. The tenor of the challenge that policymakers want to address, though, with these short-term instruments is multi-generational. Okay? So when you have it, when you're trying to solve a problem with an instrument where the tenor doesn't match, you get a little bit of discomfort in most cases. Okay? So I think that we have to rethink how you put together pieces of the financial services industry to help manage this public policy risk and basically help manage the public good challenge. So there are other solutions that people have been exploring, which I'm sure you guys have participated in the dialogue. You can look to directive management. You can deal with compliance mechanisms for caps, which is why you have, in a lot of the dialogue, cap and trade. Okay? But the question is the cap going to be enough to manage the volatility? Well, it depends on the political risk that's embedded and whether they really stick to the cap. Okay? You obviously have your alternative as taxes. A lot of people hate taxes. They don't like taxes. I'm sure you guys have had this discussion before, because who's going to take control of the money that's generated by the taxes? Some people don't like the idea of of agreeing in advance who might do that. Kind of to bridge the gap, a lot of the other dialogues that have gone on, not just in this country, but in other countries, have been, well, maybe what we ought to do is incentivize certain behavior by giving grants or loans or loan guarantees or providing tax credits. And their tax credits come in different flavors. So for example, you can have a production tax credit, and you can have an investment tax credit. You can give allowances, and there are other things. But you know what? As an underwriter, I look at every one of these, and what do I see? I see risk. Okay? And I see risk in every single one of these activities, but different kinds of risk. So when I'm asked to underwrite any of these activities or provide insurance, I'm looking at what's the risk that I'm being asked to take. And interestingly, I think people don't necessarily, when they say, gosh, we ought to do a production tax credit instead of an investment tax credit, think about the implications for the long-term viability of that business plan and what it means to us as insurers. So let me give that as a little example. I don't know how many of you have tracked the development of solar and wind, but they have been given fundamentally different classes of tax credits. Okay? The result has been, many would argue, that one of those industries developed much faster and with much more certainty than the other industry. And I would say particularly you could have that argument for a really long period of time about why that occurred or why it didn't occur, and what the characteristics of those industries are quite different as a result. But what was interesting to us is most specifically what happened in the offshore wind market in this context, which was completely, and for this our experience is really mostly in the UK. And this was last generation, several decades ago. And it was not only dependent on tax credits, but also on subsidy. And what had happened was the buyer market was buying a kilowatt hour. They didn't care if the kilowatt hour was coming from a wind turbine that was offshore or one that was onshore. But what we knew as underwriters was that those wind turbines that were offshore were exposed to much greater physical stress. All right? Maintenance costs for those things is huge in comparison to what happens onshore. Construction, CapEx, huge, okay? So when the policymakers decided, wow, we're investing a lot in these credits, I think we'll pull those back. What happened to the business models was that the business managers had to say, wow, we've got to cut expenses. Where's the big expense? The big expense was offshore maintenance. So what happened to our property policies? Funny thing. Turbines started to break down a lot more. We had a lot more property loss. So what did we learn slowly, very slowly, we're not always fast in the insurance industry, was that we need to make sure that if our risk is tied to political decision making, that we need to match up our instruments so that when the subsidy, the grant, or the other types of tax credits expire, we better be getting off of those insurance exposures unless and until we can be ensured that they're either re-upped or we can reprice to appropriately reflect the risk that now exists in that business model. Because what's the purpose of insurance? The purpose of insurance is to send risk-based price signals. That risk-based price signal is reflective of the risk that's assumed. And the part of why it's so hard for people to understand insurance is because we assume so many different kinds of risks. We assume risk for physical damage. We assume risk to first party. We assume risk for third party bodily injury. We assume liability for third party property damage. We assume liability for natural resource damages. Okay, so you have to know what the contract is and what you're asking us to assume to understand how we are going to respond to a proposed subsidy, credit, or other public policy activity. Okay? But I think what this also points up is that to suggest, as I said before, that the financial services industry is just one big blob when it comes to managing greenhouse gas risk, or to even suggest that our interests are always aligned when it comes to public policy making in the greenhouse gas or climate change area is probably not accurate. Okay? So if you want to know what our industry is thinking, don't go ask a bank, and don't go ask a venture capitalist, because they're going to have a very different interest. Their tenor of interest is very different. Their exposure to the economy is very different. Anybody know what percentage of the gross domestic product insurance represents as of about 2009? A wild guess? Global, by the way, global. Any guess? You're close, 7%. Okay? So if anybody wants to guess whether we're an important economic actor worldwide, I might suggest we're just a little bit important. And that we're very much not seen. We end up being the ultimate economic stabilizer. Okay? We're the shock absorber. Because when our assets are depleted, who gets called in next? Generally, if the private asset protection is depleted, it's going to be your government. It's going to be your local government. It's going to be your national government. And when it gets really, really bad, international assistance is requested. Okay? So the value of aligning insurance to assure protection from change in climate is critically important to stabilization. So where do we work? We work in areas not only with developed economies, with embedded particular structures, but we also work in emerging markets. But the kinds of products we sell are very different in those contexts. So in developed economies, most of our products focus on protecting individually owned private assets. Okay? And by individual, I mean it could be a corporation, but they're privately held assets or publicly held assets where you have a defined community for those assets. Okay? But by contrast, in emerging markets, most of our programs are focused on parametric programs, which are designed to provide funding to stabilize governments to allow reconstruction of infrastructure when natural disasters strike. So they are very, very different. And to be able to take an emerging economy and move it to a developed economy status, you have to develop human capacity for understanding how to assess risk and capital capacity to deploy it, to get you out of a parametric environment and into a private asset insurance. So those are some of the things that we're thinking about when we start to structure those programs, but I digress. So as you know, when we start talking about where we are with this discussion of cap and trade, our reality is we have a mix of all of these incentives. And as an underwriter, well, all that means is, wow, the risk profiles are really complicated. They're totally confounded. So as if the science isn't hard enough on the climate change, we have to look at all of the financial implications of all of this goo that everybody's rolling around in the public policy realm, saying, well, wow, we have to promote this and we have to disincentivize this. Well, all right, that means that all the risk profiles for those businesses where we've taken slivers of risk are all now changing. And it's not just about physical risk, it's about liability risk, because the government policy is changing the answer to who pays and who's responsible. So for us, this has really interesting implications, let's just say. But as I put in the paper that I handed out, I think that insurance, has a history of assisting society to deploy new technology and to adapt to change in a way that mitigates risk, as long as you deploy the tool and allow it to function in the way it's supposed to function by sending pure risk-based price signals. The second you distort that, then all of a sudden what you're doing is you are disassociating the behavior that creates the risk from the price signal. So you're telling people, don't worry, go forth and create the risk, because you're not constructing a system that says don't do it. All right? So the interesting and sort of ironic component of that is if what you're trying to do is avoid a tragedy of the commons in the greenhouse gas context, but you construct a policy that wants to incent particular behavior, but by its very nature, in fact, does not allow the risk-based price signal to be sent. You've just made another tragedy of the commons. You just haven't figured out which one it is yet. And you can't always predict that. So when you make a distorted market in public policy making, think really hard about what messages you're sending to people that you are subsidizing, that you are giving grants and loans to, that you are trying to incent. What is it doing to the risk profile? So in the case of insurance, as I said, we have a long-term history of reducing risks from things that go as far back as exploring emerging markets. If you look at hull and marine pools, where there were merchant, shipmen from Norway. I mean, pick your activity, right? There were kings and queens that sent out, their explorers, but they actually pooled their own risks, okay? Because they wanted to make sure that they could manage behavior and control things like pirates, which is really interesting. But move that forward and think about, what do we worry about with fire? Well, what you find now is we have, as a result of not only events, but participation from the insurance industry, very different fire codes than we had before. Why? Because we won't basically allow insurance for things that are going to burn down too fast and hurt people in the process, okay? Building code people agree with us, and so we meet in the middle, and we have certain building codes in which we say, well, we're willing to insure that structure, but we're not willing to insure that structure. Or, interestingly, we'll insure this structure for this price, but we'll insure this structure for this higher price. Why? Because it's either a riskier structure or it's in a riskier location for fire. So we're sending a risk-based price signal. But it's not pure, okay? So especially in the individual purchase market, in environments where we are regulated, we don't always have the ability to send pure risk-based price signals. We are required to pool in particular ways. I don't know if you guys recall decades ago, all complaints about redlining from the insurance industry. Oh, you're redlining a particular area. That is an objection to structuring a particular pooling on a particular basis, okay? So the question I think is going to come in the climate context is, what is the right pool? Should you put people who are in the first 2 miles adjacent to a forest which goes on fire all the time, get the higher rates? Or should you really spread that around the entire community? Because the existence of that community, that part of the community, has value to the overall social order. And if you do it, are you basically telling people it's okay, build more right up against the forest? Right? These are the kind of tough questions. Same question happens if you have development on a coast. Who should spread that? Should the guy that lives 500 miles inland in the same state, or more realistically, except for California, 100 miles inland in the same state, which has a very different climate exposure, be paying, basically effectively subsidizing the mansion that's sitting right on the water place? Because those are the kind of things that happen when you are required as an insurer to accept all risks into a pool. Now, as consumers, it isn't always obvious, because if you're that consumer who's in the high-risk area, do you think it's fair that you should pay that really high price? Maybe not, right? But if you're the guy that's sitting 100 miles inland, do you think it's fair that you're paying a piece of that pool? Okay, well, the interesting thing is that pooling is not always transparent to the buyer. And in fact, could theoretically be understood if you went to the insurance commissioner's office and understood how the regulations worked for insurance in the regulated market. But it's not always obvious. Now, the other interesting thing is that not all insurance is sold through the regulated market. Most personal lines is. Okay, but you get to commercial, sophisticated, big-time commercial companies, and you write on surplus lines. And then you have much more freedom to set rate and terms and requirements as you go forward as an insurer. So a lot of the other misunderstanding that occurs when you talk about insurance instruments is there's not a common dialogue about, well, are you talking about regulated personal lines insurance, in which the insurance commissioner is trying to protect its constituents who generally have never read their own home insurance policy or auto insurance policy because they're terribly dense and they're boring and they make your head hurt? Or are you talking about, a commercial, regulated commercial small business market who suffers from the same problem? Or are you talking about insurance, which is sold to very sophisticated large buyers who have teams of lawyers who pore over all of those insurance contracts and cut a deal to manage risk by determining what's the most cost-effective way for them to deploy their capital, okay? And use insurance like they use bonding, like they use surety, like they use letter of credit to leverage their competitiveness in the marketplace, okay? So I think, our industry is helped with things that are like assuring that you have improved worker safety by sending risk-based price signals, driver safety, okay? But I also think there's a great role for the deployment of new technologies, right? But this is, again, one of the areas where it's very difficult to make sure that you can get a clear risk-based price signal. Why? Because when governments start to talk about deploying new technology, what do they start to talk about? Indemnity for tort liability and indemnity for non-performance, right? So if the purpose of an insurance contract which accepted those risks to send a risk-based price signal about the characteristics of risk in deployment of that technology, which you're so interested in, wouldn't you want that if there were 2 types of technologies for sale or 5 types, but we'll just stick with 2. Wouldn't you want, as a member of society, an ability to understand that there was a difference between technology A and B? If technology A ran for 3 hours and went on fire every time, and technology B ran for 1,000,000 hours and went on fire once during that period, okay? That is where you'll get the risk-based price signal if you have an insurance contract which sends that signal, okay? But if you insert government indemnity that says, no worries, you deploy that new technology, and if it goes on fire, we know it's risky. It's okay. We'll pay. What you've done in that process is disassociate the consequence of the risky behavior from the people who design and construct. There is a balance in here, all right? And so I don't mean to say you only have one or the other. In some cases, you may need to provide indemnity if it's very long-term and there's no insurance that can go out, let's say, 1,000 years, all right? And we've actually written extensively about this in the context of CCS as a deployment issue, okay? But these are the kind of things that people have to think about before they rush into deciding that they want to give subsidies, grants, indemnities, and the like, as opposed to using a private instrument and leveraging the value of the risk-based price signal that goes forward. So as I said, our thesis is that insurance can be used and applied to facilitate mitigation and adaptation. We focus on risk to private assets. As I said, insurance is the ultimate economic shock absorber. We're about 7% of the GDP, probably not good to ignore us. This is about trying to find that intersection between public good and private asset management. But the key rub is that all of the issues that are impacted by greenhouse gas emissions are all essential services. Land use, power, water, transportation, completely regulated in almost every developed economy. So what does this mean? Nobody can do it alone. And this absolutely has to be done by public-private partnership. I can't tell you the amount of time that I spent talking to lawmakers, that I spent talking to public policy influencers, as well as dealing with academics and researchers on these issues who are sought out to give advice because most people don't understand insurance. We're a very insular industry. Most people don't think about the mechanics that go back there. They just want the protection, in effect, the indemnity when that fortuitous event occurs. So we are spending a lot of time creating products that are trying to find that alignment. But in the absence of direct government action to force integration of this economic externality, our instrument is not as leveraged as it could be because it is only sold to volunteers, and I'll explain that in a minute. But what do we need as an insurer to make sure that we can leverage the instrument to its fullest extent? We have to be allowed to use our core skills to send risk-based price signals. The second that you interfere with that risk-based price signal, you are going to have a concomitant response in risk-taking in the deployment or performance of whatever activity, task, or product that you're talking about in trying to reduce the greenhouse gas emission. Climate policy must address these governance gaps And if anybody thinks that private industry is going to fill those gaps, it's not going to happen. The only thing private industry will do is perform its role. Okay? And its role as a private industry maker is not to substitute for government. So the governments are going to have to consider how emergent risks can be integrated. They also are going to have to address rights conflicts. Things as simple as who owns the sun and who owns the wind, who owns the view, maybe a little more non-obvious, who owns the pore space, who owns the emission rights. These are all very complicated issues, but in the absence of having those issues resolved, we in the insurance industry, if we take those risks implicit within a risk assumption contract, we will be the economic funding behind the litigation, which will ensue to fill the gap where the public policymakers on an administrative basis fail to make a rule. And our willingness or unwillingness to take that step in form of contractual activity may or may not indicate whether other capital is deployed, because the willingness of insurance to enter into a marketplace often determines whether other members of the financial services industry are willing to participate. Because they might want to make a loan, but they don't want all the risks that are attendant to the exposed asset or activity uninsured. They want to spread their own risks. So it is important to think about how these actors are interacting. And they're not independent, despite what, nobody goes out generally and does this all by themselves, or if they are, they're the people in the financial services market who are willing to go boom bust, okay? And there's a limited amount of capital out there. So if you want access to that 7%, you got to figure out how to do some smoothing and how to do some long-term planning and how to mitigate some of this political risk and how to allow the reflection of the risk-based activity through price signals. So this policy has to, in other words, enable our market to function properly. The incentives have to be constructed to avoid moral hazard and market instability, and you have to consider whether financial subsidies actually undo the incorporation of the externality that you worked so hard to incorporate. And obviously, all the climate policy for us to make our products work is going to have to be regionally reflective of the actual conditions. Okay, so because everybody's got different needs, different opportunities, different solutions, and you guys know this better than we do. So the challenge for us, in many ways, is that current capital investments in essential services do not generally fully account for climate change. Current capital investments have a value that can be significantly impaired. And social organizations depend on existing agreements achieved without accounting for climate change risk, flood, fire, and by this I mean communities, governments, what you call your towns, your cities, your districts, your cantons, whatever country you're from, okay? And relocation, as I said before, is really difficult. So what can you do with insurance in this context? Can insurance spread the risk of this new exposure? Can it manage it or reduce it? The answer is it depends on regulation, okay? One of the things that we've been offering up is that building codes ought to now begin to take account for changed weather conditions, changed climatic exposure. And if one did that, just like they take account for issues associated with fire, one might expect that building codes that would require that if there were a renovation of a home, an addition, or construction of a new facility, that the construction standards applied in those contexts should be weather appropriate. Now that will increase standards, but the other issue, or increase costs, CapEx costs. But the other possibility is that you could also require, since they regulate insurance anyways, that the insurance contracts that we sell promise to rebuild weather appropriate when disaster strikes. And that could be an individual house fire, or it could be a hurricane, a flood, a typhoon, all right? So you could use that instrument to do it, but that is a accrual-based social agreement. It means that we would be allowed to charge a risk-based price signal that's reflective of the actual exposure today. Now, if people bought a home on the basis of a different kind of exposure, that might have a significant impact. Okay? Now, we have faced this in our industry before. As a matter of fact, we faced this issue when it came to flood. Right? So we dutifully went along and we sent our risk-based price signals, and guess what? Government said, man, those price signals are way bigger than our constituents can handle. Forget it. We're putting together our own pool. And instead of having an accrual-based system, what do they have? Post-loss-based system. It was supposed to be an accrual system. But what they put in place at the beginning, the theory was National Flood Insurance Program was going to be designed to provide insurance for those people who are flooded out, but it was also going to be designed to be an advanced accrual system that would be used to collect monies that would be given to the Army Corps of Engineers to construct infrastructure to do what? Protect people against floods. But when it came down to making the purchase mandatory, people didn't get as comfortable, policymakers weren't as comfortable about that, so they said, well, you don't really have to purchase it. And then the idea was setting the full risk-based price signal was causing some of the constituents difficulty, like they weren't able to pay for it. So the result was that every time we have a flood, what happens? The National Guard gets called in, right? And so who's paying for that? All of you! And where do you live? Okay? So it's pooled, it's spread, but it's spread not through that mechanism. It's spread a different way, which is not as transparent. Okay? Now, they are in the process of trying to make some amendments to the National Flood Insurance Program, and they have changed some of the rules, so I don't want to mislead you. This is a very complicated area. There are ways. But, you know, even now under this current system, the National Flood Insurance Program goes underwater, pardon the pun, about $1 billion a year. $1 billion a year. Okay? So 2 years ago, it was $17 billion under. Now it's $19 billion under. Now, given the current discussions on economics and deficits, no one seems to even pay attention to that number anymore, but it used to be a big deal. So what I think is important to understand is that people throw around, they say, oh, that's insurance. When you talk about accrual-based insurance systems that are privatized generally, in which everyone pays into a pool and it is cash, appropriately cash balanced and reserved. All right? That is a very, very different structure than a post-loss accrual or a post-loss, collection system, in which everyone says, well, we can't really collect enough for it right now. So when it happens, we'll just issue a government bond and we'll pay it back later. Okay? So in many cases, when you're talking about addressing these issues, people may think, by constructing these issues, that what they have done is actually incorporated the externality and avoided an intergenerational transfer. And I'm suggesting to you that you need to really look at the system to figure out if that's what you've actually done. Because you may not in any way have incorporated that externality, and you may in fact have just done one more intergenerational transfer in a way that's less obvious. Or you may have spread the risk if in fact the system becomes a disaster and you have to have larger governmental involvement across a much larger pool than was posited when the particular system was offered. So is this a new problem? I would say there's lots of analogies. It's not necessarily new. Or are these kinds of issues when you go not only in an emerged market, a developed market, what about when you move to an emerging market? Okay? An emerging market is a market which is not completely economically developed. Basically, the kinds of problems that you run into there, while different, are not necessarily going to be handled by any different financial instruments. So I talked to you a little bit about parametrics. I think the issue here is the money that's available to emerging markets to develop with climate change new money? Is the world economy elastic in this context? Is it willing to dedicate a greater share to address this or not? I think those are the struggles that you saw in Copenhagen, or at least I participated in Copenhagen. I'm sure there are others here who did too. Talking about, where is this money going to come from and who's it going to go to? And is this the same money that would have gone to, let's say, anti-malarial drugs? Okay, but instead you're dealing with water management. So there are lots of tough questions that are going on here, but I don't think they're necessarily all new. The issue is what problems are you trying to solve? And all of them, a lot of them, not all of them, but many of them do come down to infrastructure in terms of being able to manage it. So in the mitigation context, moving away from adaptation, current capital investments don't necessarily account, even in mitigation circumstances, for greenhouse gases. The essential services are based upon bond-type structures, and there are risks of stranded assets if you decide that you're just going to unplug certain resources that we have today. So if we're just going to unplug from fossil fuels, there are lots of investments that have been made over time in which you will have stranded assets. But interestingly, because many of them are housed within essential service structures, the stranded asset structure, if it's a regulated market, will in fact be borne in many cases by the consumer themselves through a stranded asset allocation. We've seen this before. So the question becomes, what should be done in this context as you move forward to pay for mitigation activities? And this is where I think, again, a public policy or public-private market structure is absolutely essential. How do you get in this externality? And how do you manage with a legal system which is structured actually to move against incorporation of any additional costs that are not essential? You have to get these costs then declared as an essential activity in order to get them pushed through the regulators who sit on the other side, not the environment regulators, the consumer protection regulators, okay, in order to make this work. So I think that the kinds of questions we have to ask now is, will society, and you could decide that all new build is going to be done based on commodity type structures and go away from a bond structure, but will society make that trade? Okay, and I think what you're seeing now, especially the responses to, for example, different types of levered, even power rates, but that are levered in ways that are probably more reflective of bond structuring, not commodity structuring, because they're defined, right? They're not movable every day. They're a defined band, all right? People are objecting to just that. What are they going to say if you want to say, by the way, you can buy your water, but today it's X and tomorrow it might be Y? The idea of having a developed economy is that you need some stability there to move out a lot of those highs and lows. And so I think what you're seeing is we need some different thinking in this area. So what are the options for transitioning to a low carbon economy? And in that context and with that backdrop, do we have to distort the markets for transition? I think that's the kind of question that's going to be left to people like you as you enter the public policy space with your degrees and your doing influence. These are the issues we're grappling with right now. And if you are going to subsidize, how do you transition from subsidy to unsubsidized structures? Because all of these subsidies do affect risk profiles. And they certainly can be managed by insurance, which is why we started this whole talk. But is insurance going to fix the problem? Well, it depends on what you ask the insurance to do. The insurance is just a financial instrument. That's all it is. You can change its contours. You can make it different. But remember, it doesn't necessarily do anything different than what you want your public policy endpoint to do, because it's going to respond to the law within the confines of the law, within the confines of the transaction. Okay? So you have to really think about that as you set it up. And beware of pilots. I think everybody says, oh, we're just going to do this on the first 10. Okay? We'll just give the subsidy to the first 10. Well, in many cases, it was just the first 10. But then when you tell people that now they're going to have to pay the full load of the cost, they say, but wait, those first 10 guys didn't have to pay it. And you have a very difficult issue to work with. So you need to think about your transitions up front when you're doing this. Otherwise, you may never get out of it and may always be subsidized on a go-forward basis. So I'll close by giving you an idea of some of the things that our industry is doing in terms of insurance and why they're not being fully leveraged. So, by the way, my favorite is a slide or picture on here is the cow power slide, you know, from where we're taking cow manure and converting it on a biomass basis for power generation. But what's happening to us is, as an industry, is our risk profile, our underwriting criteria are having to change, right? So we have to look at all these different kinds of new technologies. So what are we doing? In the carbon credit context, we are offering political risk coverage for carbon credits. It means if there is a cross-border transaction, what we have is a policy that basically says, if your carbon credits aren't delivered, but they weren't delivered because of the following named perils, war, riot, unauthorized repatriation, we'll pay and reimburse. It's a very complex international transaction policy. It doesn't fix all the problems, but it is interesting in the context of CDM credits. We also offer secure carbon credit securitization structures for banks. And so if there's a lender, if you can find a lender in the CDM space, I think they're almost like a unicorn at this point, but if you can find one, then we will offer a way that we can underwrite and secure their investment. Of course, we stand in the shoes of the lender if the non-delivery occurs, all right? We, in the motor context, or what you guys here in this country call auto, we offer discounts for hybrid vehicles. We are looking at pay-as-you-drive insurance. The challenge with pay-as-you-drive is that, in fact, the number of miles driven may not, in fact, be the dominant loss predictor, okay? Age, marital status, sex, credit rating may, in fact, be much more, and physical domicile of the asset may be much more influential. But in California, we are now mandated to offer this coverage, including mileage as an indicator, all right? So understand the pay-as-you-drive regulations are distorting our marketplace. And I think that it's very interesting in the context of California what that means based on income status, given how people have urbanized and suburbanized in California, and what the regression implications are. But we operate within the rules that are set up within a domicile, and this domicile has elected to mandate that inclusion. We offer all sorts of coverages for alternative energy, including full suite of what we call property and casualty, that's physical asset and liability coverages for every type of alternative energy you can think of. We offer directors and officers coverage, which includes coverage for claims for greenhouse gas and climate change related claims, which in the context of the new SEC regulations, which have now identified that there are existing guidelines related to materiality disclosures involving environmental liabilities apply in the climate context, has become very important. Now, we also offer a variety of things involved for coverage for green buildings and energy conservation insurance and CCS. But some of the things that where the disconnect and the governance gap becomes really obvious are on this last page. We offer insurance in which volunteers for commercial and property insurance can buy coverage that basically says if you suffer disaster, we will rebuild you energy efficient. We will rebuild your asset LEED certified or green, however you want to write your contract. And we'll also rebuild you weather appropriate, which in this environment might mean a special kind of roof, which is fire retardant or fire resistant, or might change your landscaping depending on the kind of disaster you suffered. But what's interesting is because the building codes aren't changed, these policies are only purchased by volunteers. So do you think we have a lot of uptake on these policies? Similarly, we offer pollution coverage for those who want to collect, reuse, and re-inject water. All right? Now, water districts in California historically haven't supported re-injection, and so we didn't get a lot of uptake on this policy when we first offered it several years ago. We do have more people exploring, wanting to do this, but it only works when the government is willing to permit that re-injection. But the value potential for leveraging this is huge. If we could take big box stores, people who paved over just oodles of space, and get them to agree to collect water and do on-site wastewater treatment and re-inject right there, or use it for landscaping, or use it for gray water inside their buildings, we could make a tremendous difference in terms of water resource management. But we can't do it as the insurance industry alone. The governments have to act, and they have to be willing to do it. And so would we support it? Absolutely. But does it matter? Not until the governance gap is filled. And we're doing similar things in the reduced deforestation area, but I'm going to stop there because I'm over my time. And thank you very much for taking the little walk on insurance with me today. And I'll be happy to answer any more questions offline as we go forward. Anyone got a question? Start with you.
mentioned carbon capture.
Oh, that's okay, I got it. She wants to know about carbon capture and storage and how we approach underwriting it. We recognized that nobody would meet their 2050 numbers in the absence of dealing with carbon capture and sequestration. Just wasn't going to happen. So we set out a couple years ago to start a project that said, how could we identify what these risks are and what do we insure? Specifically, we identified that we had been insuring enhanced oil recovery. We had been insuring oil extraction. We had been insuring hazardous waste injection. We had been insuring hazardous waste management and a lot of other similar activities for a long time. So what we did is we went in and did a deep dive in terms of risk profiling. We sat down with our customers. We sat down with engineers and identified how we could do risk profiling and determine which of those sites would meet our criteria. The result was we found a way where we could insure during the operational period those things. The objection was that everybody said you need a 1,000-year policy. And I would tell you you don't. Okay? Because what you want is you want a policy that will renew annually. Why? Because when you set the price, you're setting the price based on the existing science that is in force at that time. So if you tell me, number one, I wouldn't have any capital to go to 1,000 years, and I might have it for 30 years. Okay? But what it does is it sets a stake in time. Kind of like, dare I say in this audience, when in California you buy a house and it says this is what your tax rate is, and it never changes, okay? Irrespective of whether there's any increase in the asset value. This is much more complicated, but if we say we know this about the science today, okay, even if a new development occurred, if I was on a multi-year policy, I couldn't change necessarily the risk-based price signal. So I think what you want, and what we've always done with industrial insurance, is we send a risk-based price signal as it goes forward. So society and the investors can continue to make an informed decision about that risk-based price signal as time moves forward. So they can compare it to alternative capital investments and decide, should this continue in light of everything else that we're doing? Charlie?
It's been said that much of the damage from climate change in the United States is will be due to coastal flooding. And the insurance industry often complains that the risks can't be priced because of all the regulations they're subject to. So my question is if you could get rid of all those political constraints, is the risk insurable, and how much would proper insurance reduce the damage from coastal flooding?
I think that the answer is the risks are insurable. But I'm not sure that you can get rid of all regulation. I think the issue is the regulation has to change. And the regulation has to come up with a cogent way to deal with, in effect, what are a bunch of assets that are not appropriately structured at this point in time for their current weather exposure. And what you generally do, as we said, what you generally do is change your building codes to do that. So it doesn't mean that you ignore it. What it means is you come up with a cogent way to transition the building stock over time. It is very expensive because if you just cut it, I think, and sent pure risk-based price signals, what the politicians are saying is that would cause economic disruption. That is not manageable for the current social structure. And those are the kind of numbers that need to get run and explored to see. But I don't think that dialogue has occurred enough to figure out what that economic disruption would be if you sent a true risk-based price signal. It's a good question, though. That's where the rubber meets the road here. Behind?
Thanks. Always nice to meet a fellow UC Davis graduate. Just a question about, you mentioned 1,000 years, and my mind immediately went to nuclear waste. And how does the insurance industry value the risk associated with nuclear waste that is a long-term problem?
It's actually a really good question. And the answer is society didn't necessarily address that issue when nuclear technology was promulgated in this country. And for a variety of reasons, because there were military exigencies that presented themselves. But what society did do was aggregate a group of investors and insurance industry professionals who came up with an approach under the Price-Anderson Act to manage these risks. They created a pool, but because the risks were being managed and created both in one bucket by private industry and in another bucket by government, government said, we do not want anyone telling us what we can or can't do or influencing our risk-based price signals. We manage our own risks we'll do that. But they said for the private industry, you guys need to manage your own risks. And what was agreed upon was creating a series of mutuals or pools in which we do, in fact, send very, very important risk-based price signals to those customers about their ongoing operations. And I think that the loss history would reflect that, that during the operational period. Now, what's interesting is there was absolutely no agreement, dare I say Yucca Mountain, about disposal. But what the agreement was that the government would, in fact, because they were already setting up those management and disposal sites, they would be responsible for that, for a fee. So they set the fee for the power producers. The power producers paid the fee and expected that their waste rods, because we didn't permit until very recently any reprocessing, would be picked up and hauled away and taken by the government and managed. Funny, that didn't happen. A lot of litigation ensued, and because the payments had been made by the utilities asked that the government then pay for the short-term storage, which has turned out to be very long-term storage at their facilities. The litigation went forward, and my recollection is that the government lost, and that, in fact, there are obligations to go forward, but yet we have no storage. We have some agreement that some reprocessing can move forward, but we sit without a social agreement on how to manage risk long-term for nuclear waste. And I think we have an opportunity here in the context of CCS, in the context of other long-term technology issues, to actually come to that agreement up front, but it's not easy.
So in looking at, sorry. So to look at the difference between carbon tax and cap and trade, and understanding that these could distort a market so you're not getting the right price-based signals, is one more favorable than another?
You know, I think that it's a choice. And there are some who would argue that taxes are more efficient. There are others that argue they're so unpalatable they're not workable. I think it's a society-specific, a country-specific decision that needs to be made. So the answer is, I don't have a position one way or the other on that. My company doesn't have a position one way or another on that. I think what the answer is you figure out what the social agreement is, and you work with that to send the best risk-based price signals you can under those structures and those agreements. Is what it is. Yeah. Right.